Small business accounting KPIs to monitor in today's competitive market. Small businesses must stay agile and financially astute. Small business accounting is not merely about bookkeeping, it's a strategic tool that drives growth and sustainability. By monitoring key performance indicators, KPIs, entrepreneurs can gain insightful data that informs decision-making, improves profitability, and ensures long-term success. The role of accounting in small business operations. Accounting serves as the backbone of any small business, providing clarity on financial health and operational efficiency. Through accurate record-keeping, businesses can track income, expenses, assets, and liabilities effectively. This transparency allows owners to make informed decisions about resource allocation and future investments. A robust accounting system also facilitates compliance with tax regulations and legal requirements, reducing the risk of penalties and audits. Moreover, integrating accounting practices early helps identify potential issues before they escalate into significant problems. Cash flow management metrics. Cash flow management is critical for the survival and growth of any small business. The ability to manage cash inflows and outflows determines whether a company can meet its obligations and invest in opportunities. Monitoring daily, weekly, and monthly cash flow statements provides real-time insight into liquidity positions. Cash conversion cycle measures the time it takes for a business to convert resources into cash through sales. Days sales outstanding, DSO, indicates how many days it takes a company to collect payments from customers after a sale has been made. Days payable outstanding, DPO, shows how many days a company typically takes to pay its suppliers and vendors. Maintaining an optimal DSO and DPO balance ensures efficient working capital usage without straining relationships with clients or suppliers. Liquidity ratios as financial indicators. Liquidity ratios are essential tools used by accountants to evaluate a company's ability to meet short-term financial commitments. The current ratio compares total current assets against total current liabilities, indicating whether there are enough liquid assets to cover immediate debts. An ideal current ratio usually falls between 1.5 and 2, suggesting adequate liquidity without excess idle funds. The quick ratio offers a stricter assessment by excluding inventory from current assets since it may take longer to liquidate. Both these metrics help determine if a firm can sustain operations during periods of economic uncertainty. Gross profit margin analysis. Gross profit margin reflects how efficiently a business manages production costs relative to revenue generated from sales. This metric calculates gross profits divided by net sales, expressed as a percentage. A higher margin indicates better cost control over manufacturing processes. Variations in gross margins across different product lines provide insights into which items contribute most significantly toward overall profitability. Tracking changes in gross margins over time enables proactive adjustments in pricing strategies or supply chain negotiations. Net profit margin insights. While gross profit focuses only on direct costs associated with producing goods, net profit considers all operating expenses involved in running the business. The net profit margin is calculated by dividing net earnings by total revenues, giving a clear picture of overall profitability post all expenditures. A declining trend might signal increasing overheads or reduced sales volumes requiring further investigation. Regular analysis of this figure helps set realistic goals while identifying areas where cost-cutting measures could be implemented effectively. Accounts receivable turnover ratio. The accounts receivable turnover ratio reveals how frequently a business collects outstanding customer balances within a given period. It's determined by dividing annual credit sales by average accounts receivables, showcasing collection effectiveness. Highest turnover rates imply stronger sales performance but might also indicate stringent payment terms affecting client satisfaction levels. Balancing high turnover with healthy customer relations requires careful consideration when setting up invoicing policies. Inventory turnover rate measurement. For retail stores or manufacturers dealing extensively with physical products, tracking inventory turnover becomes crucial. This measure shows how often stock gets sold and replaced annually, helping prevent both understocking leading to lost sales and overstocking causing storage costs. An excessively low turnover rate suggests poor demand forecasting or obsolete merchandise piling up warehouses unnecessarily. Raising turnover implies improved sales velocity yet demands precise inventory management techniques avoiding frequent restocking disruptions. Debt-to-equity ratio evaluation. The debt-to-equity ratio evaluates financial leverage employed by comparing total liabilities to shareholder equity. Firms using too much borrowed money face increased risks during downturns, whereas those relying heavily on equity enjoy greater flexibility. A balanced approach aims at maintaining ratios below certain thresholds considered safe industry standards based upon sector norms. Understanding this relationship aids stakeholders understand solvency status is crucial for attracting investors seeking stable returns. Tax Efficiency Index calculation. Measuring tax efficiencies assists companies optimize deductions available legally, minimizing taxable incomes. This index examines what proportion of pre-tax profits actually remain untaxed due various allowable exemptions/reductions. Improving scores here translates directly into increased bottom-line figures, beneficially impacting retained earnings reserves. Professional guidance enhances realization potentials, ensuring no legitimate avenues missed, potentially saving thousands annually. Employee productivity per revenue unit. Evaluating workforce productivity contributes substantially towards understanding true value added versus salary paid. Dividing total revenue earned by number employed gives approximate contribution per employee, enhancing labor force utilization assessments. Higher values suggest effective use of human resources, generating more output relative effort invested therein. Detailed breakdowns reveal departments contributing disproportionately, aiding targeted improvement initiatives. Customer acquisition cost versus lifetime value. Striking right balance between acquiring new clients and retaining existing ones dictates sustainable growth trajectories. Comparisons between CAC, cost, and CLV, lifetime value, ensure marketing budgets spent judiciously rather than wastefully. When lifetime values exceed acquisition costs consistently over periods, positive ROI signals profitable expansion possibilities. If discrepancies arise persistently, recalibration efforts become necessary, reassessing promotional tactics employed previously. Operational expense to revenue ratio. Assessing operational expense structures clarifies portions consumed from every dollar earned operationally. Dividing sum allocated to running day-to-day activities against generated income yields useful percentages representing overhead burdens. Keeping such ratios manageable sustains healthier profit margins, especially amidst inflationary pressures creeping up prices everywhere. Periodic reviews enable pinpoint identification inefficiencies, ripe targets for trimming, thereby boosting bottom lines visibly. Fixed asset utilization rate. Promoting productive usage among fixed assets prevents unnecessary depreciation losses, harming balance sheets negatively. Calculating utilized capacities compared against purchased totals highlights equipment/real estate being left unused, squandering capital investment. Boosting utilization means extracting full potential returnings back into coffers, benefiting reinvestment cycles positively. Investigations uncover reasons behind underperformances, enabling corrective actions. Restoring asset performances adequately. Return on investment for key projects. Every substantial expenditure warrants scrutiny regarding resulting benefits derived subsequently. ROI calculations compare gains achieved minus original outlays, establishing actual worth realized over durations elapsed. Positive outcomes validate wise spending choices, encouraging similar approaches going forward. Negative results prompt reconsideration. Alternatives exist, eliminating unprofitable ventures, promptly preventing ongoing drainages. Break-even point determination. Identifying break-even points assists anticipate minimum sales volumes required, covering all expenses incurred completely. At this stage, neither loss nor profit exists, making it pivotal reference marker guiding operational scales appropriately. Knowing exact numbers allows better forecasting capabilities, adjusting staffing/resource allocations accordingly preemptively. Sudden fluctuations warrant updated computations reflecting latest variable/fixed cost estimates accurately. Working capital management effectiveness. Managing working capital efficiently preserves sufficient funds circulating continuously, supporting core functions seamlessly. Analyses focused around ratios like current ratio alongside cash conversion cycle assessments detect vulnerabilities, proactively addressing them timely. Optimizing components comprising receivables/payables/inventory ensures smooth transitions, maintaining momentum undisturbed. Effective stewardship maintains resilience, withstands unforeseen shocks, preserving continuity uninterrupted despite external volatility. Conclusion: monitoring these vital KPIs empowers small business owners with actionable intelligence, shaping smarter choices, impacting bottom lines favorably. Establishing regular review routines coupled with professional advisement fortifies fiscal foundations, guaranteeing longevity amidst challenges faced inevitably along journeys ahead.